the problem P6-29, so I'll start it. Pine owns 70% ownership of Bob and 30% of non-controlling interest of Bob. We have known that the purchase price is $108,500. The fair value of non-controlling interest, which is also given as $46,500, will use the purchase price minus the fair value of non-controlling interest to get a fair value of Bob, which is $155,000. The book value of Bob, which is also given as $100,000, So we use fair value divided by minus the book value to get a differential of $55,000. The differential made up of buildings and patents. Buildings and equipment is $20,000. The useful life is 10 years, so we use 20,000 divided by 10 years to get $2,000 per year, and then times the ownership of 70,000 to get $1,400. It's the same thing for patents. We use $35,000 of patent divided by the useful life of 5 years to get $7,000 per year, and also times the ownership of 70,000 to get $4,900. December 2002, Bob purchased at $32,000, sold it to Pine at $48,000, and then Pine sold the $27,000 cost of goods sold, which led to a remaining inventory of $21,000. On 2003, Bob purchased at $60,000, and sold it to Pine at $90,000. And then we can get a remaining inventory of total remaining inventory of $24,000. 23rd, Pine sold at $30,000 downstream to Bob, and sold all the remaining inventory of remaining inventory of $22,400, which led to a remaining inventory of $7,600. So the ending inventory will be $7,600.
For the equity method entries, first we accounted for the income that Pine would receive from Bach. So we debited investment in subsidiary and credited income to subsidiary for $17,500, which is 70% of the total income from Bach of $25,000. And then next we debited income from subsidiary and the investment in the subsidiary to account for the amortization, which is $6,300, and we got that from adding the total differential that you would amortize each year. And then we accounted for the dividends, which we debited cash for $10,500 and credited investment in subsidiary for $10,500, and that number is 70% of the total $15,000 of dividends declared by Bach. And then we deferred the gross profits from from Bach from the intercompany transfers, and for the first purchase in year 2003, the upstream purchase, where Bach sold inventory to Pine for $90,000, and then Pine resold it sold $66,000 of the $90,000, and had unrealized profits at the end of the year of $5,600, and we solved that by taking the remaining inventory from this transfer and dividing it by the total purchase, so it was $24,000 divided by 90,000, and multiplying it by the beginning unrealized profits, which were $30,000, because Bach purchased the goods for $60,000 and sold them for $90,000, and we got a total unrealized profit of $8,000, and we multiplied it by Pine's 70% interest in Bach and got 5,600. And then for this third transaction, we also debited income from subsidiary and investment in subsidiary for $3,800, and here we divided the remaining inventory by the total purchase again, which was 7,600 divided by 30,000, and multiplied that by the beginning unrealized profits, which were 15,000, because they sold it, or Pine purchased it for 15,000 and sold it to Bach for 30,000, and we got $3,800. And here we recognize the full amount in this entry because it is a downstream purchase. So any profits from this would just be Pine's, and the non-controlling interest doesn't have anything to do with that. So then for the purchase that was made in 2002 and the sales that happened in 2003, we had to do a gross profit deferral reversal. So we debited investment in the subsidiary and credited the income from the subsidiary for $6,300. And we did that, or we got that, because the remaining inventory at the end of 2003 was $21,000, and we divided it by the $48,000 purchase and multiplied it by the beginning unrealized profit of $16,000 to get $7,000 that were still unrealized. But during the year they sold the inventory, so they were realizing profits. However, this total $16,000 was still in these accounts as unrealized profits from 2000X2. So we subtracted $16,000 minus the remaining unrealized profits of $7,000 to get $9,000 that were realized in 2000X3, and then we multiplied that by Pine's 70% ownership to get $6,300 for this entry.
Okay, so this is the basic elimination entry. We debited common stock, retained earnings, income from subsidiary, income to NCI, and credited dividends, investment in subsidiary, and non-controlling interest. The common stock, retained earnings, and dividends were all given to us in the problem. The investment from subsidiary, income to NCI, investment in subsidiary, and non-controlling interest were all calculated. We used these calculations to get those. The income from subsidiary was the percentage of subsidiary net income minus their percentages of the unrealized profit, and then we added back the reverse gross profit deferral because we're recognizing it at this point. We did the same thing with the income to NCI, where we had 7,500 minus their unrealized profit, and then added back the realized gross profit deferral. Here we took the book value, the ending book value of the subsidiary, which we got over here in these calculations, and subtracted their percentage of unrealized profit, and then added back the gross profit deferral. And then after we did those entries, we did the differential reclassification entry, where we debited buildings and equipment, patents, credited accumulated depreciation, investment in subsidiary, and the NCI. The buildings and equipment is depreciated. The patents get amortized over time. The buildings and equipment hold their value, and they get depreciated to the accumulated depreciation account, where we calculated it was 2,000. So net of 4,000 at this time, because it's 2 years, 20x3. After 1 year, it was 28,000, and now it's just amortized another 7,000 for a net of 21,000. We got the 11,000 and the 25,900 after they're calculating through the percentage and after subtracting the changes from the beginning value, we got these two numbers.
For our amortized differential entry, we debited amortization expense for the patent for $7,000 and debited depreciation expense for buildings and equipment for $2,000, and we used the total values for that we calculated earlier, the 2,000 and the 7,000, and then we credited income from subsidiary for 6,300 and credited income to non-controlling interest for 2,700, and that's just the 70-30 split of ownership. And then for our intercompany inventory consolidation entry, we debited sales for 120,000, and that's for all the sales in 20x3, the 90 and the 30. And then we credited cost of goods sold for 108,200 and credited inventory for 11,800. And we credited inventory because with inventory we recognize the profits when it's sold, and we got that number from the total unrealized profits for B and C of that year, which is the 8,000 plus the 3,800. And yeah, again, we recognize profits by changing cost of goods sold. So until this is sold, we need to devalue inventory by that amount. So then for our last entry, for the sales of stuff bought in 2002, we debited investment in subsidiary for 11,200, debited non-controlling interest for 4,800, credited inventory for 7,000, and credited cost of goods sold for 9,000. Now this inventory for the 7,000 is credited because it's still unsold, and the cost of goods sold was, the 9,000 was sold. So with the total of that, this is the 70-30 split again for the investment that they have in Bach.